right, welcome everybody to another LFI Lunch and Learn. Today we've got the group back from GSP REI. They were here last week actually doing a scouting report that we have ready to go out and email today. So those of you that didn't catch these guys on Friday, that'll be coming out to you today, but we'll also get the Lunch and Learn recorded and we'll get that out the next couple of days as well. But a lot of good content from these guys. Looking forward to what you brought to share with us today. But Peter, I'll turn it over to you, I guess, and you can run through.
Sounds good. Well, Chad,
Awesome.
Thank you for having us today, and I appreciate you having us back. Like I was saying, we have a full schedule. We're doing a presentation tonight for one of your subgroups, so we've appreciated the response from the group so far, and we've just given a little bit of information. So we're trying to take that one step further today. So as I said, thank you, Chad, for having us and the LFI team. And thank you to everyone who's joining this webinar live or listening to the recording. Really appreciate you taking time out of your day to listen to us and learn from us. And, we're going to present a lot of different stuff, and I'll provide contact info at the end. So if you have questions and things like that, we're available for you. So just to kind of kick it off, give you a little bit of background on GSP REI. This is us by the numbers as of the beginning of October 2023. So we started in 2019. Our first fund launched November of 2019. And there was two funds, GSP1 and GSP2, launched quickly after that. We paid fixed rate returns in both of those funds. We still have investors in them, and we've fortunately paid our consistent returns since inception in both of those funds. Right now, we have 3 active funds. 2 of them are for accredited investors. They're 506c funds. That's what we're here to talk about today. I give you the full picture, though, to kind of give you an idea of our ability to execute and our overall track record. So we also have a first mortgage fund that is all the capital raised for that is through an exclusive institutional partner. So if you combined the assets under management, it comes out to a little over 57 million. So our rental portfolio is about 17 million and about 40 million through first mortgages right now. That comes out to about 100 rentals, just under, and a little over 320 first mortgages. So we're actively managing over 420 rental properties and then loans. A lot of what we do on the loan side, too, is very active. So it's not like it's just all, workout agreements and things like that. A lot of the first mortgages we buy tend to be vacant. So we do a lot of actual physical asset management to those properties. So the institutional partner has committed over 150 million for the first mortgage strategy. And since our inception, we've raised over $10 million from accredited investors through our 506c funds. So the portfolio, that's diversified over 40 different states. For the most part, our rental portfolio is going to be in Maryland, Pennsylvania, and New Jersey. Our office is based outside in the suburbs of Philadelphia. So we tend to focus in that area. We grew up in those markets. We know them very well. And our construction and property management teams are located in that area. The first mortgages, that's in over 40 different states. So we have a lot of experience working out of state from our, home base. So what are we going to cover today? It's going to kind of be a version of what we did the other day, but we're going to take everything a little bit further. And hopefully, we'll answer the question to why single family rentals make a great fund investment. So we're going to talk about our specific strategy. We're going to talk about the people behind it, the management team, myself included, and my partner, Ron, who's with us today. We're going to talk about our model and the 2 funds that we have open, and we're going to talk about the impact that investing in affordable housing has for communities and people. And then we'll have plenty of time for Q&A. So a lot of you guys are probably familiar with multifamily syndications and other commercial syndications. And probably a good way to kind of think about what we do is we syndicate scattered site, single family affordable rental housing. So that means, we're typically going to buy an attached or a detached 2 to 4 bedroom home And it's typically going to be scattered site, meaning they're going to be spread throughout, Philadelphia or Baltimore or certain parts of South Jersey. We do have specific locations that we really want to focus on. And we'll get to that in a little bit, and we'll talk a little bit more about, the advantages to scattered site and all that kind of stuff as we move through the presentation. So, but essentially what we do is we raise capital from accredited investors through our funds, and then we'll use that capital to purchase property and to do a renovation cost. And then we do portfolio refinances, which creates liquidity and allows us to keep buying. So the capital that we raise is typically going to go towards fully distressed properties and value add properties. We don't shy away from land either. There's a lot of opportunity in that space. But for now, our primary focus has been on the fully distressed properties. And the value add side, we'll do a combination of what we call, occupied value add. So typically there's going to be existing cash flow, but it's going to be under market. So when the tenant's lease comes due, we'll assess at that time. If it makes sense, we'll terminate the lease, and then we'll go in, add value, and bring that rent up to market. The full distressed properties that we buy are typically vacant, and we're going to bring them down to the studs or even to the brick, do full renovation, and we're practically handing over new construction at that point. So we like that for a number of reasons. One of them being is it's a lot less maintenance for us down the road because the tenant's walking into a practically a brand new property, and then they typically come at it with a different mindset as well, because they're getting something that's really high quality, brand new, everything's new, appliances, everything soup to nuts. So what we do is we purchase a variety of portfolios and individual properties. There's advantages and disadvantages to both. One of them that we really like when it comes to individual properties is we're probably going to get the greatest discount when we buy an individual property. Portfolios are typically going to have existing cash flow, which is a great benefit to that side. So we like to buy a combination of portfolios, individual properties, and like I said, just a combination of distressed and value add overall. So our target markets are going to be primarily Baltimore, Philadelphia, and South Jersey, with a really strong focus on Baltimore. It's one of those that we'll get into it later on in the presentation, some of the reasons, some of the things we look for and that kind of thing. But, because we invest in affordable rental housing, we want to be in markets where there's a really strong demand for rentals, a strong demand for affordable housing. And Baltimore is one of those places. We could pick up properties at a really good price point. There's plenty of jobs in that area, people that commute to Washington, D.C. There's a lot of jobs around the areas that we buy in. One of them being we tend to buy around hospitals because that generates a lot of work and a lot of economy. And then it's kind of the same thing in Philadelphia too. We as investors and developers, we look to fill a need. So we look for those value generators that are and that could be like a hospital or a business district, but it's also going to be transportation as well. Unfortunately, for a lot of people, they're not going to be able to work right where they live, so they need to have properties that are affordable, that are close to transit. Certain parts of South Jersey make sense for us, but for the most part, it's the taxes are make it hard to pencil out in South Jersey. So there's a few areas that we like. There's a few areas that we have property now that we would like to scale up in. But for the most part, our focus is going to be Baltimore, Philadelphia. And when it comes to scale and things like that, I'm going to touch upon that and some of the benefits of it just in a few minutes. So acquisitions channels, where do we acquire our assets? It's a combination of different things, and we don't really lean heavily on any one of them. We like to be looking at all of them, and they kind of ebb and flow, throughout the year and over the years and things like that. So we'll buy a lot of stuff off market through wholesalers and real estate professionals and people like that. We'll buy on market deals. Baltimore has a very, very strong auction presence compared to other cities and even like Philadelphia. It's different. You'll find a lot of off market and on market deals end up on those auction sites. Occasionally we'll do direct to seller, especially where we have properties on streets that we really like and we want to expand our footprint there. there. So we'll do, mainly that's going to be phone calls. So looking up, owner information, making a call, seeing what we can do from an acquisition standpoint. We have relationships with government service entities such as HUD. For the most part, or a lot of our first mortgage product will come through HUD and other government service entities. And the way we look at notes from a rental perspective is we're just getting it at a cheaper price point. In the long run, we're either going to dispose of the property if it doesn't fit our rental model, or if it's not in our identified areas, or if it does fit the rental model. If it is in one of our target markets, then it's going to be something that's held. So we go through foreclosure. Typically, those properties are vacant. And then we'll keep that as a rental property. Occasionally, we'll have access to REO product as well. That's another thing that kind of ebbs and flows. So what is affordable housing? That's a question that I get all the time. It's kind of a large, a large thing, affordable housing. It can kind of mean a lot of different things, and there's different types of affordable housing. But the way we look at it is really the way that HUD looks at it, and the way that HUD defines affordable housing. It's housing that requires less than 30% of an occupant's gross monthly income. Now, that can be achieved in two different ways. It could be done naturally. So we usually define that as workforce housing. That's going to be anywhere between 30 to 40% of our portfolio. So it's non-subsidized. Middle income is kind of another way to look at it. The tenant's typically making too much to qualify for subsidies. About 60 to 70% of what we focus on is going to be subsidized affordable housing. So that is typically going to be through a Section 8 voucher. So it's the tenant that has the subsidy and not the property. That's one of the big differences between a single family affordable housing compared to multifamily with the HAP contracts, and it's structured differently. So typically that tenant's going to come along with a Section 8 voucher, and we are willing to accept that. And there's a number of reasons we like that, and we'll get into that in a moment. I think it might be coming up next. So why affordable housing? There's a couple reasons why we like affordable housing. Obviously, like I said, as investors and developers, we're always looking to meet a demand in a market. And when it comes to affordable housing, I could argue, I don't think there's another asset class in the real estate realm that has higher demand than affordable housing and lower supply. I have a couple notes on this. So Nuveen, they are the asset management division of Teachers Insurance and Annuities, TIAA. They own a ton of affordable housing, and they've been buying up more and more of it. They did a couple big trades earlier in the year. Through their studies, they say that nearly half of all U.S. renters are considered rent burdened. That means they're allocating more than 30% of their income towards rent payments. So even more are considered, even more concerning, is the fact that 1 in 4 of those rent burden tenants are what they call severely rent burdened. So they're spending more than 50% of their income on rent. The National Low Income Housing Coalition estimates that the nation faces a shortage of 7.3 million rental homes that are both affordable and available to extremely low income renters. So that is for every 100 households in that income bracket, there's only 33 affordable rental homes that exist. So obviously there's a massive under supply and a huge demand for affordable housing. And that's not just in urban areas. We tend to focus in the cities and the surrounding suburbs, but that is all areas, metropolitan, suburban, rural, and everything in between. So going off of some more Nuveen research and some of their statistics that they've come up with, managing their portfolio and looking at the data, affordable housing provides favorable yield throughout the entire economic cycle. That includes recession. So when they compared traditional real estate sectors, such as regular apartments, multifamily, self-storage, retail, industrial, they saw that affordable housing has generally delivered higher yields over the last 20 years. It has a tendency to avoid downward rent adjustments during times of recession. Usually, recession is going to cause for more demand within the affordable housing and those types of units. So, and like I just said, just the scarcity of affordable housing drives the demand at the end of the day, and drives higher occupancy rates as well. So, kind of all that plays into a favorable yield throughout the entire economic cycle. Government subsidies. So, like I said, about 60 to 70% of our portfolio is going to be subsidized through Section 8 vouchers. And out of that rent, about 90% of the rental income will actually come from those programs. So the tenant's not paying a massive amount of the rent here or anything like that. The vast majority of the rent is coming through the federal government through that Section 8 program. So obviously that provides reduced risk. It enhances the cash flow reliability and just overall provides a certain layer of security when it comes to the collections. And those checks would come directly from the federal government to us as the landlord. Another thing too is it aligns with public and private impact investing goals. So there are public, private, state, local, federal initiatives on all level that want to see more and more affordable housing. There's certainly a lot of red tape to cut through and things like that. But a lot of that tends to be more on the development side. Whereas for us, we're focusing on existing primarily and redeveloping. So there's a little bit less red tape in that perspective. But at the end of the day, what we do and the strategy that we deploy is very much in line with what state and local and federal and public and private, all those different factions, what they want to see at the end of the day. And we'll touch a little bit more on the impact as we go on. So single family, why do we invest in single family? That's a big question I get. I kind of been joking recently. We were at the Bigger Pockets conference, and a lot of people asked me like, well, are you guys going to graduate up to multifamily? And we certainly do not look at it that way whatsoever. We love single family rentals for a variety of reasons. We'll touch upon some of them right now. But we'll start with, just consistent income. And a lot of that goes off of kind of some of the things that we've been saying. There's a massive demand for single family rentals, and there's an undersupply. So really since 2008 and a little bit prior to that, we have not been building as many homes as we were before. So I have some numbers here from CNN. It was the gap between single family home construction and household formations has grew to 6.5 million homes between 2012 and 2022. So multifamily in some areas have certainly picked up on that, but I'll constantly say, in that regard is, if you look at the data and you just ask, people, where would they rather live, a single family home or a multifamily apartment? I think it's 8 out of 10 would typically say they want to live in a single family home. So there's more demand for single family housing. To give you some perspective too, from a new construction, I think it was in 2022, less than 4% of new construction single family was valued or sold for under $200,000. So for us, we're typically going to be focused, we'll get into our model in a little bit, but we're typically going to be focused under that $200,000 mark. So there's not a lot of barely any at all new construction coming online to satisfy the demand in that space. There's a massive opportunity to scale within the single family space. I think I'm going to touch upon this in a little bit too, but I think a lot of people get this wrong about single family, but I understand too, if you're looking at it from a mom and pop perspective, how many single family homes do you want to manage? And do you have a 9-to-5 job, or do you have other, things in your life? We're a fund and we're a business. So there's a ton of opportunity to scale, and there's a lot of benefits similar to multifamily. There's the economy of scale, and there's savings created within the scale of single family, between with key hires and things like that. So diversification, that's on a bunch of different levels, but, with single family, you're diversified over a large amount of properties. They could be in different states, in different cities, different streets. So there's a lot of benefits of diversification within it. It also, too, we don't need millions and millions and millions of dollars to, execute on our business plan. And like I said, we'll get into our model in a little bit. We like the flexibility within single family. So our properties can be rented or they could be sold. And typically on the sale side, it's going to be, to a first time home buyer market, which is typically, the strongest market throughout any economic cycle as well. So we like the flexibility. And then the flexibility on the financing as well. So recently, most of our portfolio refinances have been 30-year fixed with the 30-year AM. But we do have options too when it comes to, 5-year, 10-year terms and a 30-year amortization. There's interest only options. So there's a lot of flexibility in the financing that you don't see on the commercial side. So let's see. Mythbuster. All right. So you might be thinking, everybody always knows that person who's invested in affordable housing and they had a tenant that just totally trashed the place. Is that the case all the time? No, it's definitely not. Honestly, we have not had any tenant that has completely trashed a property or anything like that. And when we when we purchase our properties, we're taking everything into consideration too. So if we have an occupied value add or something like that, we really want to hand over, whether it's purchase distressed or value add, practically a new property. Something that, we're not putting lipstick on a pig or anything like that. But a lot of the issue, I think, with affordable housing tenants is, I don't know how people do their tenant screening, but for us, we're professional landlords, and we do a hefty amount of tenant screening to try to avoid issues with tenants as much as possible. And we really, and Ron can attest, and my partner Wade, both of them have been doing single family rentals individually for going on 25 years. They've had issues in luxury homes that they've owned. They've had issues on the affordable housing side. So it's going to span the spectrum. And with scale, you're always going to have issues and things like that. But overall, we have found the demeanor of our tenants is they're happy to be where they're at. They're happy to have a nice, clean, high quality home. And a lot of it, too, is going to come back to, the experience that you provide with property management and how aggressive you are with issues and things like that. So a lot of times when I hear people who have had issues with tenants in affordable housing, I question, what was their tenant screening process like? And then what was their property management experience process like? And usually that starts to peel away, some of those issues. Another myth buster here. One of the big questions we get is, isn't scattered site single family rentals impossible to manage? And for us, no, not at all. And for, Invitation Homes and American Homes for Rent and Vinebrook and all these other institutional players, they own a lot more properties than we do. And that is something, I think some of them certainly have challenges within the space when they get as large as they do. But advancements in technology from a property management and construction management, just overall operational, management, has made managing scattered site single family rentals very possible. And that comes back to what I was saying before, where there's massive benefits within scaling in a certain area. So that's we tend to focus in Baltimore and Philadelphia because we would like to get our unit counts up in those areas, because there's going to be economies of scale created. There's going to be more opportunities for in-house hires and things like that. That's going to bring our overall costs down and just create efficiencies within the management side. So, but I do understand this kind of misconception when it comes to mom and pop and, people who are managing, small scale units, especially if they are maybe lower income and they're bringing in, lower income tenants, that kind of thing. I could see why people could have challenges on managing that, along with everything else. If they don't have the proper operational team, then you're gonna have issues with it. So, and that's we'll kind of get into that in a moment as well with how we manage our properties. But that's one of the reasons I think investing in a single family fund is a great investment, because if you have a really strong operational team behind it, they're going to be able to create value and provide consistent cash flow, maybe more so than you could on your own. So, speaking of that, let's talk a little bit about the management team. So we have over 80 years of combined real estate investing and business experience on our management team. My partner Ron's with me today. Ron and I co-founded GSP back in the beginning, middle of 2019. And Ron comes, it's going on 25 years at this stage of the game, in construction management experience, in just overall real estate investing and consulting within the space. So he manages our in-house construction and property management, kind of oversees it from the top. And then I as well oversee the construction and property management alongside him. And my chief responsibility is going to be dealing with our investors and, making sure they understand what our goals are, what our visions are, what our fund offerings, what they provide, and, answer any and all questions and things like that. I started my career over 9 years ago raising capital for distressed mortgage funds. And there's huge advantages that I really like about doing the construction in-house, the property management in-house, and being able to acquire and execute on distressed and value add physical property. Our partner, Wade, he has same thing, going on 25 years of real estate and note investing experience. At one time, he managed over 600 single family rentals, mainly throughout the South. So he comes with a lot of experience within the single family rental space. But he runs our note purchasing cycle, acquisition, loan workouts, modifications, foreclosures, everything that happens on the note side of our business. And he maintains those relationships with HUD and different banks and servicers and financial institutions. And he's always looking for avenues for us to find cheaper price points on the hard asset side or on the paper side that will lead to cheaper price points on the hard asset side. So he plays a very active role in really both sides of the business and how the synergies between them. Brian is he's our vice president of construction management. He brings over 10 years of construction management experience. He's really managing our crews, our what we call our project managers. So the guys who are on site and who are, making sure that our projects stay on time and on budget. And Brian works very closely with John Havey, who is our vice president of property management and development. So John comes to us with over 20 years of property management, real estate investing experience. He's done a lot of student housing, self-storage, just regular single family rentals, small multifamily. So a lot of experience throughout the years. And he's working with the tenants to make sure that they're having a great experience, make sure that we're aggressively managing the properties, taking care of any and all issues that arise, and then working closely with Brian as our crews are going to be doing the maintenance and things like that. So for the most part, we do all of our construction and property management internally, and I'll expand on that in a moment. John also keeps key relationships with utilities and different state and kind of local providers when it comes to the affordable housing and attorneys and things like that as well. Bodie. So a big question we get all the time is GSP, REI. What the heck does GSP mean? The REI is probably, everybody could pick up on that, real estate investments, but GSP stands for German short-haired pointer. So we're all dog people. Ron's got 2 German short-haired pointers now. Our partner Wade has 1. He's had him his entire life. So these dogs are very energetic. They're very powerful dogs. They're committed. They're enthusiastic. They're intelligent. And we felt that those personality traits were very much in line with the way that we look at single family rentals, real estate investing, the markets, property management, everything that we do. So we kind of felt that name was fitting. So that's why, and you can see it in our logo too, the dog. So let's talk about our operations team a little bit. So like I said, we are a see where we're at on time. Okay. Our operations team. So vertically integrated, we do all the construction and the property management in-house through our teams. We do sub out some projects like HVAC and, things like that would make sense that our teams just aren't as skilled in as a subcontractor might be. But for the most part, everything is done internally through our crews. So technology driven, our property management team runs and is fueled through top industry software. So a lot of the tickets and maintenance issues and things like that are all going to go through those portals, and it just streamlines the entire process, makes everything that we do a little bit easier. We're 30 members strong right now. That includes the management team, our accounting department, the legal and compliance departments, as well as the construction and property management team. So I want to leave plenty of time for questions, but I wanted to give you some idea of like the properties that we buy and give you some numbers. So on the screen, you'll see a property in New Jersey and a property in Philadelphia. You can see those numbers, and I'm sure in the recording you can go back and offline we can always chat over these numbers. But typically I'll give you our kind of our model as we kind of look at these. So here's properties in Baltimore, a couple sample properties. So we typically want to be all into a property for $120,000 or less. That is the purchase and the renovation cost. So there's going to be distressed properties that we buy. There could be in the realm of $15,000 to $30,000. They're typically going to look like this when we acquire them, and then we're going to put $90,000 to $100,000 or so into properties like that, and we're going to see an after repair value of around $185 on average, and we're going to rent that for about $1,650 or so on average. We also buy value add properties. As I said before, some of those are occupied value adds, so they have an existing tenant. Typically, that's going to be an under market rent. Others are going to be vacant value adds. Either way, we'll probably buy those properties for around $50,000 to $75,000 or so, and put, or $60,000 to $70,000. Put about another $40,000 to $50,000 or so into it. So depending whether we're buying distressed full gut renovations or we're buying value add properties, we typically want to be all into the property for $120,000 or less. For the most part, what we do is relatively cookie cutter. We do get discounts on certain things and we buy in bulk, but for the most part, what we do is relatively cookie cutter when it comes to the redevelopment, kitchens, the bathrooms, appliances, flooring, paint, all that kind of stuff. It streamlines the process with our crews as well. But we certainly, because we do the volume that we do get some discounts on bulk. So we do look for those discounts as well. But tile, vanities, any and all appliances and things like that, we try to keep it somewhat similar because it just streamlines the process and is easier for our crews to get in there and do that. So just a couple samples of the outside. Like I said, a lot of what we do in the urban areas are going to be more attached single family homes, and then in some of the suburbs and the parts of South Jersey, there'll be more detached single family homes. So, like I said, we went to some really extenuating circumstances to try to be as conservative as possible in our modeling. So in here, you'll see, we added to our all-in costs. We deducted our after repair value. We decreased our occupancy rate, increasing our vacancy rate, and we right now the 7.25 on the refi, that makes sense right now. We have a refinance going on right now. For the moment, it's about 6.5. But we have another one that will soon be following. That'll probably be in that 7.25 range. We've stressed that all the way up to 10% to take in the current interest rate environment. That rent at $1,475 is really low. So if you bring that up to our average of about $1,650, that 10% number still makes sense with the numbers that we project in our growth fund. So like I said, we have two different funds. We have an income fund and a growth fund. Both are Reg D 506C funds, meaning we can generally solicit. They do only accept accredited investors, and we need representation on file. They're both structured as LLCs, so the investor's liability is limited to their investment. We work with personal cash entities, self-directed retirement accounts, checkbook control retirement accounts, trust. And here is just a little breakdown. So our growth fund is more of a traditional profit and equity sharing fund. So we pay a set preferred return that provides a monthly foundational payment to the investor. And then we split the profit 50-50 between us and the investors. That's distributed semi-annual upon availability. And then there is growth. The equity is split 50-50. So we look at that as about a 5 to 7 year hold for investors. We do regular refinances. That was another thing in our modeling to try to be conservative. We put one annual refi. We're typically going to do at least 2 a year. So we create liquidity through the refis. We're certainly not a disposition model. We don't want to sell anything. Not that we occasionally don't, but for the most part, we want to continue to lease and manage. And that's really our payday as the fund managers at the end of the day, is paying our investors back and continuing to lease and manage and hold that rental portfolio. We also have an income fund right now that is a fixed rate, fixed term fund. So investors pick the term they'd like to be in, whether it's 1 year, 3 years, or 5 years, and there's a fixed rate associated with that. Our other two funds, GSP1 and GSP2, that are closed to new investments, they were both fixed rate funds. So we paid between 9 and 12%, depending on the time frame and some structural things. And those, like I said before, they've paid consistent on-time returns since inception. So a couple of the differences, like I said, I'll kind of leave it up there for a second in the recording if you want to go back, but I want to get plenty of time for Q&A. So I'll kind of wrap it up though from my presentation wise. I want to leave the best for last. So like I said, it's not just a great return and a great fund investment, but there's also a lot of positive impact when investing in affordable housing. We're going into underserved communities and revitalizing, blighted properties. So there's a lot of positive impacts from an individual to families to communities. It stimulates economic growth in these areas. It addresses housing inequality, overall improves health and education, and reduces homelessness, just to provide a couple of those impacts. So I went through a lot of stuff. I've started to quicken myself up a little bit because I saw it was 1:40. So I want to leave plenty of time for Q&A. So my contact info is on there. So if you're going through the recording or, you have any questions that don't make it up right now, always feel free. That's my cell phone. You can call, text me anytime. My email address is there, and our website, gsprei.com. You can get a bunch of information, other webinars and things like that we've done on there, as well as schedule a call with myself and Ron and Wade. We're all available for you.
Cool. Thanks, guys. I appreciate you coming on and sharing some details about the single family syndication model compared to what we see a lot of. So I think it was very interesting to go through. Forgot to mention in the beginning, but please, anybody that's online, feel free to drop questions into the Q&A at the bottom, and we'll have these guys take a crack at the answers for that. But really interesting stuff. What's the scale that you usually try to buy on, purchase on? I guess it kind of just depends on what you got in the fund. Is that kind of how you approach? Or do you generally, you're looking for portfolios, I assume, but what's the scale you usually are looking for when you go through that process?
Yeah, the model on the Karen Growth Fund with a $5 million raise over 5 years should be roughly a little bit over 300 properties. So, we're kind of limited to how much capital we can raise at the end of the day. That's one thing that I really like about our model. Well, too, we do everything in-house, and we want to continue to do everything in-house. So it's kind of a tortoise and hare kind of thing for us as well. I mean, we want to make sure we can continue to provide the streamlined processes on the acquisition and the redevelopment, but also provide a really great experience for our tenants and the overall, company and the people that work for us and all. I think that's some of the issues that some of these really large institutional investors have run into over the years, where they've gotten so large the experience to the individual, the tenants and the homeowner, the rental occupants have had a horrible experience because of that. You know what I mean? So we're kind of always that dance between how much capital is coming in, because we're typically going to purchase and renovate with that capital coming in, and then we're going to do our portfolio refis. So but yeah, there's a ton of opportunity from buying individual properties, but also buying, more portfolios and these mom and pop type, portfolios, where people who've been growing portfolios over a number of years. And we've looked at portfolios and acquire portfolios upwards of 10 or 15, 20 properties. And we've looked at some that were 300, 500 plus. I mean, so there's a lot of opportunities. And when you look at the space overall, less than 3% of single family homes are owned by institutional investors. And a lot of times they are going after, especially recently, the build to rent communities, whereas we're going after the scattered site. And a lot of them too that tend to not focus on the workforce and affordable housing side as well. So there's a lot of opportunities to scale in this space. So we're gonna look at how much capital can we raise, and then how much can we actively deploy responsibly with our in-house structure, that kind of thing.
Yeah, makes sense. On the flip side, and forgive me if you covered this, I was multitasking while you were going, too many plates to juggle these days. But on the flip side, your exit strategy, then, who are you selling to when you go to close out of these? Does that go more to larger institutions that are looking to buy a portfolio, or, and forgive me, I don't know if you were perpetual holds or what the case was, but just curious what the exit side would look like too.
Yeah, we're definitely going to be more of a perpetual hold, so we buy to pretty much hold forever. Not that it wouldn't make sense to sell properties at a certain time, and we're always looking at that. But there is opportunity from a sale perspective to institutions, and there's also opportunity to sell to more of like a first-time home buyer. So it's one of the things we really like about the flexibility of a single family syndication is there's a number of exit strategies when it comes to holding and refinancing, or bringing in a larger institutional partner to either buy out existing investors or to sell to the portfolio to them. And then there's also opportunity to liquidate through, just the on market and, to regular home buyers, that kind of thing.
Yeah, makes sense. We did have a couple of questions pop up in the Q&A that I'll hit. On the website, you mentioned tax advantages. Could you expand on what those are and how those are involved?
Sure. So the income fund does not have tax advantages. So that was in that slide where there's the differences between the growth fund and the income fund. So I'll clarify, with the income fund, it's a fixed rate, fixed term, no tax advantage. The growth fund has the tax advantages. So the growth fund, the investors essentially own 50% of the fund. So they're going to have 50% of all the tax advantages that come along with the ownership of the real estate. So essentially it's, going to be the depreciation. We're also working with cost segregation engineer to kind of see what we can do from a accelerating and maximizing the tax advantages as well, taking everything into consideration when it comes to the long-term nature of what we do as well.
Makes sense. Next question was K1s. How would you describe the amount of depreciation per year, et cetera, that we could expect from an investment in this kind of a fund?
Ron, would you know that question better than I, or?
Well, so the growth fund opened this year. This is our first growth fund. So as Peter mentioned, we're working with cost segregation engineers right now to look at our existing portfolio that we're bringing. Part of that portfolio has already gone into this fund. So we don't have an exact number on that at this point. Another factor is looking at, when we acquire properties, as Peter mentioned earlier, some of it's value added, some of it's distressed. And as the fund as our business has grown, as the funds have grown, we focus more and more on what's really our sweet spot, and that's the distressed properties. So right now we're analyzing, the cost segregation analysts are looking at our makeup over the last 3 years of distressed to value add, because it's obviously going to be different from a depreciation standpoint. and looking more at the last year and a half of what we bought, which is leaned much more heavily towards the distressed. And when we accelerate the depreciation, what does that look like? So we're in the process right now of getting that answer. It would probably be a little too early to estimate, but we plan on having that here in the pretty near future.
Very good. Next question was pertaining to the markets that you invest in. Again, somebody was on late, but could you speak to the different markets that you focus on?
Yeah, so Baltimore is going to be our primary focus. You know, we can get the best price points from an acquisition perspective, and the rents are pretty much in line with what we see in Philadelphia and South Jersey. So that's a market that we really like. Philadelphia is our other focus. We like the diversification between the Baltimore market and the Philadelphia market. And then, like I said, too, during the presentation, there's a massive benefit within the scale of a single family portfolio. So we would really like to expand our portfolio in those markets. However, we do look at other markets and have identified markets that are close to us, kind of also in our backyard, as well as other markets throughout the country that we really like as well. But for right now, our main focus is going to be Baltimore and Philadelphia. And our portfolio is in South Jersey as well. And there's a few markets that we like there, but it's definitely not a major focus for us.
Great. The next question in here is, did I hear that your distributions are semi-annual? Why not quarterly or monthly? Can you speak to kind of the logic behind your distributions?
Yeah, so in the growth fund, we do profit. So it's like I said, 6% preferred return with a 50-50 profit and equity split. So the preferred return is paid monthly. So that is a monthly distribution. That's kind of the investor's foundational income stream payment each month. And then the profit distribution is done semi-annual. So upon availability, it would be paid at the end of June and the end of December. In the income fund, that is also monthly distribution. And that kind of feels more like debt. So it's like whatever the investor invests, they take their set return, divide that by 12, and that's what they should expect to receive on a monthly basis. And there's a compounding option in there as well. So we do monthly payments on the preferred return, but for the profit distribution, that's the semi-annual one.
Thank you for the clarification on that. The next question was related to distributions with the monthly or with the growth fund. The monthly payments that are coming from it, is that spread over 5 to 7 years? I think you talked about that a little bit, but can you re-emphasize the structure of the growth fund for distributions?
Yeah. So as Ron had said, our first two funds were the income fund structure. I mean, so we had a fixed rate, fixed return, and that was what I was used to too. Before starting GSP, that was the funds I was raising capital for had that. So I had investors and relationships where I knew they liked those fund structures and the predictability of that. So that was one thing. Investors over the years have always been asking for upside and tax advantages and things like that. So that was why we went to the drawing board and looked at what we've been able to do over the past couple of years and came up with the growth fund and modeled it out based on what our, what we did and our actual numbers and averages over the past couple of years. But one thing we wanted to do to also try to help it to feel a little bit like our income fund was model out that preferred return as a monthly distribution throughout the entire life of their investment. So that the preferred return in the growth fund is paid monthly and distributed each month, throughout the entire thing. And the way it feels is it's just if you take for the growth fund, it's a 6% preferred return. If you take 6% of whatever you invest, divide that by 12, that's what you should expect to receive. Chad, I think you're muted.
Sorry, the dog went crazy here, so I forgot I had that mute button, but this is the Zoom life, right? The work from home life. The next question was related to the growth fund as well and asking about the projected yearly performance. Can you speak to that a little bit more? I think you kind of enhanced there, talked about it a
Yeah.
little bit there,
So that was because and two, to be respectful of the lunch and learn format, I didn't put in the projected returns and things like that. In the future,
no, we
we'll do a
appreciate
deal.
that.
Yeah, we'll do a deal webinar where we will get into those. But I would say if you go to gsprei.com, you can our Invest With Us page has the projected returns. The income, the like I said, the income fund is a fixed rate, fixed return. The growth fund are projections based off of a 5-year hold. And there's options for the investors if they want to get out earlier, they want to stay in later. But the other thing too, I would say, is if you download the pitch deck off of, or you look at any of the documents off of our website, you'll see more projections and things like that. But we'll do a deal webinar and in the future here, and we'll get into those numbers and how we come up with all that kind of stuff. But just to be respectful of the format, I was one of the reasons I didn't provide that in this webinar.
We appreciate that, Peter. Actually, no, this was structured as a lunch and learn. This was supposed to be educational, teach people more about the single family asset class kind of thing. So no, we appreciate that. We didn't slip into the deal pitch too much here. Next one here is, will this be will the growth fund be closed at some point, or is it evergreen?
So we want the investors to look at it as a 5 to 7 year hold. So we have a number of investors who ask us, could they stay in later or could they get out early? I mean, so kind of both sides of the spectrum. So if, the essence of the growth fund is to grow that fund. I mean, so I could definitely see opportunity to stay in beyond the 5 to 7 years. And two, the longer you're in, the more properties we own, the more cash flow there is, the more appreciation there is. So those numbers, and you'll see this too in the modeling and those projections, those numbers go up and up, and so there's you're kind of rewarded for your patience in the growth fund by not taking a larger preferred return like there is in the income fund, so that more of that capital can be reinvested into the portfolio to grow it over time, and you're sharing in all of that growth and all the profit from that. But with the way we've written into the paperwork is starting in the investor's third anniversary, they can request redemption. At least on an annual basis. And we kind of have always operated from a best efforts liquidity. I mean, we understand things happened, and I've been doing this long enough where things pop up. So we're going to take everything into consideration. With the growth fund, it's one of those things, like I said, the goal of that fund is to really grow that fund. And by doing regular refinances and raising capital in that fund, that's how we grow it. But we did want to have like a set, 5 to 7 years, and we want to give them a time frame and have the a clear way of getting out of that fund. So it's certainly not an evergreen structure compared to like our income fund, which is a little bit more set in stone. That is, you're in for a 1-year term or 3-year term or 5-year term, and that is 90-day call option. And if we don't pay and that kind of thing, like we have it structured where investors take voting rights, take control over the assets in the fund. So we try to put our money where our mouth is at the end of the day, and make sure that we've set returns that we feel that we're going to be able to comfortably pay over the next however many years that term is.
Awesome, great, thank you for that. We're almost at the top of the hour. It looks like questions have dried up as well. If anybody has any other questions while we got them live, feel free to ping that in the Q&A real quick. Here Joe threw in 2.3x over 5 to 7 years. Again, I'd say download the presentation, the pitch deck that you have to find out details on that, Joe, if you're interested in more. But also, if you're interested, have other questions, please feel free to reach out to these guys. Their contact info is right here on the screen. We are going to probably try to get you guys scheduled for a pitch webinar, so we'll get into the more details of the performance and track record and all that kind of stuff too. At that point in time. But thank you guys for coming on today to do the lunch and learn and share the information about it. Thank you for being on the Scouting Report last week as well. So
definitely. Thanks for having us, Chad. Yeah. And we appreciate everybody who's joined us live, everyone who's listening to the recording. And like Chad said, we're always available. So you have questions, you want to dig deeper into anything we discussed or anything we didn't discuss, always feel free to reach out, and we're happy to help you. But pleasure being here, and appreciate the questions and all that makes it fun and, and that kind of thing. So that's awesome. And we'll look forward to coming back, doing a deal webinar, and we could jump into the details on the funds and, you know, how all the things we did to kind of stress test and try to be as conservative as possible, but also give justice to, you know, the overall market that we're in right now and the opportunity in single family affordable housing.
Absolutely. No, we appreciate it as well. And thank you to the group for all the questions. Good stuff. Good luck tonight as well with the next round.
Thanks.
Yeah, if you live in the area, I think there's still some room if you want to come by Adelphia, New Jersey. We'll be there with the Triple D Mindset subgroup. So we'd love to see you in person.
You guys will be sick of LFI here before long. All right. Thanks, guys. And thanks to everybody that tuned in. We appreciate it.
Thanks again. Take care.
All right.
Thanks, Chad. Thanks, everyone.
Yep.